On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of On Tape podcast. I'm Dan Nathan, joined by Guy Adami. Guy, welcome.
Where's EY from SoFi?
Oh, there it is, right out of the gate.
Right out of the
taking
gate.
a little her time, I think, okay? And that's fine. She's entitled. She's going to come back, ready to go when we get back. But here's
Let me
the
ask you
thing.
a quick question before
Yeah.
we get into it. Wouldn't her time be our time if you think
I
about
see-
it that way? See what I did there?
I see what you did there, Mr. Hand.
Well,
But
it is
here's the
fast
deal.
times in the market, by the way. Let's get into that.
It is fast times. We got a lot to discuss here. We have a market that is absolutely melting up. On the year, the S&P 500 is only up about 1.5%. We're recording this Monday in and around the open, and the futures are indicated up 30 basis points. So off to the races. Some of the usual suspects, Guy, driving a little bit of the action. We're going to get into earnings this week. We have some big tech names starting to report, and really the bulk of the Mag 7 is going to come next week. So we're going to talk a bit about earnings. We have some economic data that could be dictating the course of, or at least the perception of, rate cuts that are kind of quickly dwindling as far as the March meeting. I think we have maybe a 46% chance. That's the CME Fed Funds tracker there. So we'll talk a little bit about the data and the dot plots. And we also have China melting down as the U.S. is melting up. Do you want to start there? Because this is an interesting juxtaposition, if you will. The Shanghai Composite is trading at its COVID lows, can't get out of its own way. And, it's interesting. A lot of these kind of early 2024, predictions that we hear from investors and pundits and the like, a lot of people want to kind of like China here because the sentiment's so bad, but it keeps getting worse as the U.S. market apparently gets better.
If you're looking at through the lens of a couple different things, so FXI is obviously the first thing I guess people will punch up on their screen outside of obviously sort of the indexes specific to China. But the FXI is the one we'll look at here. And below 21, which is the indication right now, we're obviously taping this Monday morning. That would be the lows we've seen 16, 17 or so years ago, and we'd be breaching the lows that we saw in October of 2022, which is remarkable if you think about it. So there's clearly something going on. Now, the problem I have, of course, is when things are going well in China, that obviously adds to the bullish thesis here in the United States. China's very important, I get it. But when seemingly things deteriorate, people don't seem to take that into consideration. Now, quite frankly, maybe they're right not to, because as you said, the S&P is effectively at all-time highs, and NASDAQ is off to the races. But I guess the question one has to ask themselves is, at what point, if any, is the weakness in China going to have ramifications here in the United States? And as of now, the answer is, well, it has none whatsoever. But, I got to believe that's just a matter of time as well. And that's just one of the other many concerns that I've had for quite some time now, Dan.
Yeah, no, it's interesting to me that, the FXI, which is, a bunch of the large, and we know the names, the Alibaba, so Tencent, so some of the big tech companies, but it also has some big banks, it has some big industrial companies in there. And to your point, it's, really near those 2022 lows. It's below its COVID lows. If you look at the Shanghai Composite, it's just a few percent away from its COVID lows. The Hang Seng in Hong Kong is getting absolutely destroyed today. So there's something there that local investors are a bit worried about, right? At a time where the Chinese have indicated that they want to kind of at least stimulate their economy a bit. They want to support markets a bit. There was an article over the weekend, and I know we spent some time, I think it was probably in the fall, talking about the youth unemployment rate and what that could mean for the Chinese economy. But it's an interesting split screen. And I put it in our group chat a little bit, is that we keep hearing about new measures of youth unemployment. So the Chinese are trying to, I think, fudge the data there a little bit to make it not look so bad. And then on the flip side, some of the smartest people that I know on economics and basically geopolitics in general, they keep pointing to the fact that this changing demographic in China by like 2050, they are going to go from 1.3 billion people or so down to below 1 billion, maybe as low as 800 or 900, a billion people, which is astounding. And the implications for their economy. When you look at the Middle East, which is so quickly trying to scurry away from their dependence on oil, right? And you look at China, which is dependent largely on this very cheap manufacturing, right? And they have their share of natural resources and the like. There are some really interesting demographics underfoot here. And so again, I don't know what it means, but Chinese investors, we get made fun of as pundits all the time, Guy. Remember there was a time last year when I think all of us on the desk on Fast Money said Chinese equities were uninvestable, and then they proceeded to rally 20%. They really are uninvestable for all intents and purposes if you're just thinking about it through the lens over the last few years of a US investor and where opportunities are, what we rely on. But I'm just curious because to me, it's getting kind of close, Guy, because the
Uh,
sentiment can't get too much worse.
100%. And I think if I'll go back in time, I think it was early June, late May of last year on a Monday when, the weekend you had similar news as that we're hearing now. And, the network talked about the uninvestability, and that's a word I just made up, of China. And we actually talked about potentially that being capitulation. Now, in retrospect, they're right. China was uninvestable then, but China's also very tradable. And that, I think, was the
Yeah.
point we tried to make back then. And we did it through the lens of like an Alibaba, I think, which proceeded to rally somewhere between 35 and 45% over the next couple of weeks. That stock, though, again, if you wake up this morning, you're talking about a stock that's probably has a 67, 68 handle, the lowest we've seen in quite some time. So it's been deteriorating now for the last 3 years, as has been the FXI, quite frankly. But along the way, there have been opportunities to trade it from the long side. So it's interesting choice of words. I'm not saying that you're using, that market pundits use. Investability. Yes, I would say again, right now, given all the unknowns, it's uninvestable, but it's certainly very tradable. And maybe today's going to be another one of those days. I'll be looking at Alibaba in terms of the volume that it trades, maybe see some capitulation. It typically trades about 21 million shares a day. We'll see what it does today. But those are the signs you're working about, you're looking for, excuse me. But to your other point, at what point does it have ramifications here in terms of their economy? Because they have a demographics problem. And I don't think the market is properly considering it here in the United States.
Yeah, and just to your point about Alibaba, and one of the reasons why so many folks focus on that one, obviously it's a huge part of the FXI, right? So if you're looking at US listed names where, you think you have a certain level of security from a transparency standpoint, they have $112 billion in cash, okay, less than 25 billion in debt, $176 billion market cap. So you do that on an enterprise basis. I mean, this stock is really, really cheap relative to almost every peer in China and then many of its US peers, and then expected to its growth. So to me, at 67 and a half, which is where it's trading right now, Guy, the low in 2022 was 58 bucks. You can just do the math there. I mean, this thing gets really cheap really quickly on its way down if you do have a sort of capitulation. But I think your main point about what China growth or lack thereof means for the rest of the world, right? So we have an S&P 500 that is back at all-time highs, as we just discussed. We have the S&P 500, at least investors, okay with a 10-year yield in and around 4%, with an S&P trading about 19 and a half times forward expectations, okay? So here, this was a tweet over the weekend from Andy Constant, who's been on Fast Money with us, and
Hmm.
we should probably have him on the pod. And I thought this was a really good one. So if we're going to talk about expected growth and we're going to talk about expected rate cuts this year, so this is what Andy is tweeting about. The Fed dot plot assumes 3 cuts in 2024. 3 factors drive that assumption: 1, inflation falling; 2, real GDP falling; and 3, monetary policy. Lately, the market and policymakers have focused entirely on number 1, but number 2 and 3 matter as well. To validate the 3 cuts, GDP is projected to fall from 2.6 to 1.4% in 2024. If it doesn't, then almost all the cuts in 2024 would not likely manifest. For 2023, great progress in fighting inflation has occurred, but that's last year's story at best. This will be about how the real economy handles current rates. Will GDP fall a lot, or will it be stronger for longer? For now, I pick the latter. I want to get your take on this because, again, the Fed dot plots are assuming 1.4% GDP. We're going to get Q4 GDP, I think, on Friday, which is expected to be 1.7%. So a recession would be 2 negative consecutive quarters of GDP. We really won't know that until after the fact. But the stock market usually should start to discount that if we start seeing weakening data. Thoughts on that? Because I think this is a really important tweet. He's saying inflation falling was last year's story, GDP or real GDP falling, and monetary policy are 2024.
Yeah, I think that's probably right. I think we all understand what's going on the inflation front. And again, falling, yes, but basically going up slower than it has been going up. It's inflation is still going higher, but again, nuanced but important to point out. But GDP is probably the story for 2024 because let's just say to a certain extent the Fed has slayed that inflation dragon or in the midst of doing so, right? The next bogey they obviously have is going to be the economy and on the broader front in terms of GDP, but more importantly, even than that, I think, in terms of the unemployment rate. Now, that's either working for them if you believe in a soft landing or working against them a little if you think that, they probably want the unemployment rate somewhere north of 4.5%. So the rate cuts are predicated on a number of things. But if unemployment remains sticky, with a 3.738 handle or so, and GDP doesn't crater, one has to ask themselves, what's the impetus to cut rates in 2024. There's really no reason to do so. So, again, going back to the market, so much of the market rally, I think, has been predicated on the belief that we're going to have 4, 5, or 6 rate cuts this year. And I just don't understand why that would happen unless, as you've pointed out, and a number of people pointed out, something is breaking along the way.
Yeah, and I guess, listen, it's January. We had that first week of the year where we saw the Magnificent Seven sell off. A lot of folks were doing victory laps, right? Like they were like, well, that was it, people. We just needed to get through the end of the year, and people were waiting to sell some of the biggest leaders. When I think about earnings season, Guy, that is quickly upon us, and I think about expectations for S&P earnings growth in 2024, a lot of it is still predicated on the performance of that Mag 7, right? And so, like, you tell me, you know what I mean? Like, a lot of folks were getting excited about the broadening out of the rally towards the end of the year. It just didn't really seem to materialize. The fact that they got right back to some of the biggest names, Nvidia is up 20% on the year. This is nearly a $1.4 trillion market cap company, drove a ton of the performance in the S&P 500 last year, up 230%, right? So we have, Apple, which is down 5.5% after 3 downgrades in the first 10 days of the year, got upgraded. Now it's unchanged on the year. We're looking at Microsoft up 6% on the year. Google is up 5% on the year. Amazon's up a couple percent. Meta is up nearly 9% or something like that. So, like, look around, man. It's the same story as 2023, but now it really comes down to what are expectations for growth outside the US? What are expectations for cuts? Because to your point, if some of these dynamics, whether it be unemployment just stays kind of stuck where it is or whatever, right? If we end up being in a stagflationary environment and the Fed can't cut and the long and variable lags, right, that we've heard about now for 2 years since the Fed started raising interest rates,
Hmm.
if they start to kick in, might we be in a period that maybe it's great for people, who are, looking for jobs? There's plenty of jobs. Maybe it's great for wage inflation, right? But maybe we are stuck in a sub 2% GDP environment, right? And maybe margins don't go higher for S&P 500 companies, and therefore that should weigh on S&P valuations that are trading above 5 and 10-year averages per fact set, which I think we're trading about 19 and a half times expected 2024.
Yeah, I think that's right. And then obviously that leads to, what type of earnings environment are you going to see under those set of circumstances? I think the consensus, and I don't have it necessarily in front of me, but I want to say it's like $240 ish in terms of earnings. We'll see how that comes out. But the other side of that equation, again, that you bring up is what is happening in terms of the yield curve, which people seemingly have forgotten about. 2 years versus 30 years has flattened out. So that's one of those pretty good indicators. And Liz Young talks about it all the time. The inversion is sort of when the clock starts. It's the re-steepening of the yield curve is when you have to start to get worried about things. Now, 210s is probably hovering, depending on the day, anywhere from 20 to 35 basis points or so, still inverted. But what happens if that starts to flatten and then reaccelerate or steepen? That's obviously over the years been a bit of concern. Now, Dan Greenhouse, who we had on the podcast, I want to say 2 or 3 weeks ago, pointed out that there's probably enough data to support my argument. It's sort of a handful of times that's happened, and that's fair. But with that data, it still suggests that once you start to see this re-steepening, typically bad things happen on the back end.
Yeah, and I guess on the company front and the earnings front, just going back to this is an article in the Wall Street Journal last Tuesday, the 16th, which I thought is interesting, especially on a week that saw the market make or close at a new all-time high. Profits come back paired with rate cuts make a powerful mix, guy. Companies put the earnings recession further behind them in the fourth quarter, even as rates are set to start falling. Profits are growing again, and the Federal Reserve looks as if it will start cutting rates sometime this year. It is an unusual combination, and for the stock market, possibly a potent one. So I just think that's interesting that's how that was like an A1 story in the Wall Street Journal last week, a shortened holiday week that saw the markets just kind of rage all week long, and some of the greatest hits were leading us there. I mean, that is kind of the soft landing economic
Hmm.
bull case for stocks right now.
Yeah, 100%. And people have been making that point pretty consistently for the last how let's call it year or so that this could be the absolute ending of this entire thing. They can thread this needle. They can get us to this point where the unemployment rate doesn't sort of spiral higher, somewhere between 4.5%, 5%. Maybe it tops out a little north of 4%. The inflation rate, although still growing, obviously starts to continue to decline. That's a good thing. They're not massive layoffs, getting back to my unemployment rate thing. And you're going to start to see a reacceleration of margins with inflation coming down because demand is still robust. Yes, I guess all of those things can happen, but there's still a lot of bogeys out there. And we haven't talked about the credit concerns out there, just in terms of countries and their debt loads,
Yep.
United States not least of which. So there are a lot of things out there. I brought that up to Steve Eisman a couple weeks ago on Fast Money. He didn't seem to be at all concerned. And quite frankly, I guess, unless the credit markets start to get concerned, there's no reason for me to be concerned. But I'm telling you, that's out there as well, Dan Nathan.
Well, you and we came into 2024 and I think we had a New Year's resolution. I know you're not one to do those sorts of things, so I'm just
No.
kind of calling it. But we said that listen, we got a lot of things right in 2021 and 2022, and 2023 was kind of a frustrating year because I think we got turned around a little bit with the Q1 with the Silicon Valley Bank and what that sort of kind of monetary accommodation and some of the fiscal stuff that was going on, and it really just kind of trapped us in our kind of
Hmm.
bearish broad market view. And we said we're going to be a bit more constructive this year. And to be fair, and some of the folks who kind of listen to us every day and show up every day as we do here, they realize that there's some nuance to that sort of thing. I mean, I fully take getting a couple big things wrong, and then also just kind of never turning on the S&P 500. But this year, I think it's going to be a bit more opportunistic as it relates to individual stocks. I think we're going to see more dispersion in different names, especially in technology, as some really do get to harness the benefits of the AI investments that they've made and commercialize them and have that drop down to the bottom line, where others are going to be revealed for what they are. It's just Johnny come lately is trying to ride a train, and then there's going to be sector stuff like so. Here's one guy, and I want to get your take on this. So if we kind of agree that maybe rates right now are not going to come down as much as, let's say, a lot of investors thought they were just a month ago, some sectors start looking appealing, to you. Or if the flip side of that was, it's just say expectations for a rate cut start to pick back up for March, might some sectors look appealing to you? Let's say like utilities, which have sold
Yeah.
off 5% in a straight line. Like there's going to be opportunities in the stock market to make money on an intermediate term basis without getting the macro 100% correct.
Yeah, and that was true to a certain extent in 2023 as well. I mean, there were pockets of opportunity without question. And I share your thoughts on 2023. I'll tell you that in retrospect, Silicon Valley Bank and First Republic to a lesser degree. I mean, I thought that was going to be, and I'll use the word catastrophic for the economy and the broader market. It probably turned out to be the best that had happened, maybe not necessarily for the economy, but clearly for the market because of the liquidity injection we saw on the back end. I obviously did not take that into consideration or completely look past it. So, my bad, as they say. With that said, to your point, if the rate story is sort of in the rearview mirror, let's say rates just don't really move in 2024 the same way they moved in 2023, which I don't think is unreasonable given how vastly, given the moves we saw all throughout 2023. One has to ask himself, what's going to set up? Well, I think first thing people will turn to are the banks. They'll say we're in an environment now where banks can figure things out. Their balance sheets are fine. Maybe those holes in the balance sheets somehow were fixed by this rate move. I think to a certain extent, maybe this reacceleration in the industrial sector. But I still think healthcare, which again at points last year was sort of left on the roadside, is going to come back in a meaningful way. We've already seen the M&A picking up late last year, early this year. So yeah, you're right. There are a number of pockets, but then don't underestimate what potentially could happen in the energy sector. Again, if you start to see I don't want to say a reacceleration, but if inflation stays persistent and commodities get back on the horse for any number of reasons, geopolitical probably the biggest one, and again, demand is still at pre-COVID levels, maybe the energy sector, which again has been left for dead, starts to pick up as well.
Yeah, and again, I think that's probably one area, energy for one. I think, healthcare on valuation. I think that if rates were to come down, let's say precipitously, and it could be for economic weakness, you'll see money maybe move back into consumer staples and utilities, as we just kind of talked about. The bank's a little interesting here, Guy, because we had that huge reversal from JP Morgan
Hmm.
from its opening gap after its earnings, and then we saw Bank America and Citi and Wells and some of the names that had been underperforming, let's say JP, really turn around and give back most of the gains of the prior month or so. So the jury to me is still out. And again, this is all, you know, everything that we're talking about right now about new highs in the S&P and our ability to maintain them. I take you back to 2 years ago in 2022 when we had a lot of similar headwinds. We had uncertainty about a Fed, we had uncertainty about geopolitics, right? We had certain uncertainty about S&P earnings growth, right? And I don't see us in too different of a spot. In fact, the S&P is what 1.5% away from where we topped out. And all of a sudden, inflation fears picked up, right? The Fed and what they had to do to combat that, you know what I mean, only got more entrenched in markets and valuation and kind of weighed on the economy. And here we are, at the exact same spot. And we have a greater dependence on a small group of stocks that have captured the enthusiasm about one of the biggest secular shifts in technology that you and I can remember in 20 years. To me, that does suggest that there's an accident waiting to happen as we get into earnings. Now, this week, it's going to be Netflix. Who cares? Okay. Like, again, you and I threw that out of FANG a long time ago because it's just an inconsequential name in market cap terms and everything like that. Intel, what they have to say, this is one of those potentially Johnny come latelys that joined the AI party late last year and had a massive run up, right? So let's see what they have to say
Hmm.
because to me, if they do not execute well, relative to expectations with AMD and let's say Nvidia in the GPU space, that stock's going to get thrown out very quickly. And then at the end of the week, all eyes are going to turn to the consumer with American Express on the higher end. Like those three earnings, I think are really important to get a read on the consumer, get a read on investor, sentiment as it relates to valuation. What are you most focused on? Because obviously this time next week, all we're going to be talking about is obviously the Mag 6.
Yeah, I agree with you. And listen, chips, obviously, Texas Instruments, we hear from this
Yep.
week. So, the move into chips has just been spectacular. And, I get it to a point, but it's interesting. I mean, I don't want to belabor the point, but Taiwan Semi, if you look at their quarter year over year, look where the stock was last year, look where the stock is now. The stock's probably 20 something percent higher on earnings that are 20 something percent lower year over year. So there's
Yep.
a disconnect unless you say, you know what, everything was trough and their sort of guide for the year is going to reaccelerate things. Okay, I get that as well. And I understand the importance of Taiwan Semi, but American Express, and if you go to our Instagram page or mine or yours, you'll see that American Express is what I'm really focused on this week. And the reason is what are they seeing on the credit? Do they have credit concerns, loan loss provisions, those types of things, delinquencies? Obviously, a much more affluent client than a Discover Financial, but this is a barbell thing. And Discover Financial obviously saw something on their end. Is American Express going to start to see something on their end of the spectrum later this week? So I'm sort of focused on that.
This will be interesting to see how the market reacts on Wednesday after the close Tesla reports. Now, one of the big bulls, Adam Jonas from Morgan Stanley, who had, I think, a $400 price target. This stock is trading at $212 right now. I think its all-time high, Guy, in late 2021 was $400. Half of his valuation has to do with full self-driving, autonomy, and robots, and software and AI and all this sort of stuff. Okay, so he just took down his numbers pretty dramatically. It's a supply demand thing. Too much supply to waning demand, and therefore
Hmm.
you're going to put pressure on full self-driving. This story is going to end up being a lot like the iPhone story. The bigger the installed base, the greater margin you're going to make on services, which is going to be full self-driving and all this other stuff. So he's taking down his estimates pretty dramatically for 2024. He's taking his price target down, I think, from 400 to 345 or something like that. So it'll be interesting to see if this company does come in line. Let's say the margins are a little weak. Let's say that they guide down a little bit, or at least the guidance suggests that there's going to be weaker demand. We know that they just had another price cut. It'll be interesting to see with the stock down 20% in the last month, dramatically, underperforming the S&P 500, how investors treat this. You and I and Danny Moses have made the case on this podcast probably dozens of times over the last year. The fundamentals have been deteriorating for this company. We've seen gross margins go from over a year ago from 25% to 18 and a half or so for automotive, and probably trending lower if Adam Jonas is right about supply and demand. So to me, why is this stock important? Well, it was up 100% last year, despite the fact that earnings got ratcheted down fairly dramatically, and the fundamentals, in my opinion, competition in China and Europe is getting worse, right? But the stock rallied, but it's still well below those all-time highs. So how this stock reacts is really important to me this week, guy.
The reaction to your point, and you've made this point, that when fundamentals have mattered in this company, four times minimum a year on the back of earnings, and then a few other times in terms of, deliveries and those types of things, that's when the stock typically doesn't do particularly well. The rest of the time, when it gets caught up in sort of the FOMO, the excitement of the broader market, is when it starts to levitate. However, we've brought up this pennant formation in the stock. You talked about that all-time high. You have a major downtrend line that is still intact. The uptrend line over the last year or so has been violated to the downside, and now it feels a little bit broken. Yeah, I guess you could see rallies along the way, but that downtrend is still intact. And as much as it is an innovation story, it comes down to a lot of ways margins, and you've seen margins deteriorating. And I think there was a hope that lowering prices, it would be offset by robust demand, but you're not seeing that. And at a certain point, that hurts margins. And they said a year and a half or so ago that margins would start to decelerate, but they wouldn't get down to legacy automakers margins levels. Well, guess what? We're precariously close from doing exactly that.
Yeah, and I guess, again, to your point, guy, the last 3 times that they reported earnings, the stock has sold off at least 9% the day after, right? So the difference here, I would just say, is that the stock is down 20% in the last month, and that's a pretty difficult setup from a trade standpoint. I think the options market is implying at least a 7% move in either direction, but that one is on my radar. Last thing here, guy, I just want to mention this because Danny Moses is kind of mentioned this a bunch over the last few months or so. He's like, take out, Tesla from the Mag 7, it's no longer magnificent, at least from the standpoint of what's going on with their fundamentals and the way the stock has really kind of been stuck in the mud. If you look at it on a multi-year basis relative to the S&P 500, and when it was added to the S&P 500 a little over 3 years ago, it's down from that period, while the S&P is up maybe 30% or so. But like some of these names, like an AMD, that you want to look at on the back of, let's say, an Intel guy, if you look at that RSI, I mean, and you've mentioned this on a million occasions, the stock traded as low as $90 after they reported their Q3 results in late October. Okay. The stock is now trading at $172. Just do the math. Pretty overbought. Like for a company like this to put up a quarter in guidance where the stock can go higher with an RSI, relative strength index, where it is, it's nearly impossible. They would have to do something that nobody is expecting to do. So let's just talk about where we are with some of these really beloved names right now. They seem almost too good to be true at a time where the S&P has done the impossible. It's gotten back to the all-time highs.
Yeah, I mean, if you believe the whole secular growth story and there's this new paradigm shift and all the things you've heard now for the last year or so, that's fine. And you can continue to believe that without question. But with that said, at a certain point, stocks, regardless of what's going on, do get to levels that just don't make sense in terms of, as you said, relative strength index, stochastics, and the different things. And in terms of specifically a name like AMD, that's exactly the case. Not to, again, say anything bad about the company. It's a wonderful company, but people have been zigging when they should zag. I mean, remember, this is a stock a couple quarters ago that people were unanimously bullish about, at around 135, and obviously then traded basically straight down. This last quarter or so, when they reported, people sort of the knee jerk reaction was to sell the stock, only to see, to your point, effectively double. So, as bad as the setup is to push shorts, probably in Tesla right now, and I think that was a point you're making, it's probably equally bad to sort of lever your long positions in a name like AMD.
Yeah, I think that's a really great point. And again, here we are. It's the market's open. It's trading very near 4,900. We know a
Yep.
lot of S&P strategists or strategists out there have 5,000 targets and the like that they were putting on in early December. Where we're almost there, people. It seems like there's a level of euphoria and comfortability about the Fed's path forward, despite like this lengthening period of time that we've had this inversion on the 210 spread, despite what's gone on with China, despite the, I think, concentration enthusiasm, and again, in a small amount of names, and we're losing maybe one by one, and we might lose a few more over the next couple of weeks. So you and I are going to keep a close eye on that, and we're also really excited for us going down to Miami, early next week to the iConnections Global Alts Conference. It's going to be a great vibe check on just kind of how allocators are feeling about, like just kind of
Hmm.
how managers are feeling about putting money to work. So that's going to be really interesting for us. You and I are going to be broadcasting market call from down there. We're going to be doing an on the tape down there. We're going to be doing a bunch of stuff on stage. We're going to be doing fast money for 2 days down there. Guy, are you excited to be down in Miami Beach next week?
Thrilled, especially the time of year that it is. But yes, that's important. But more importantly, I mean, this is a conference where you have a few thousand people, very transactional in terms of what gets done. Allocators get lined up with people they're investing in. And it's a lot of fun to hear some of the excitement and enthusiasm about, again, obviously some of the different funds that are down there, some of the different ideas that are down there, and what the allocators are thinking. So it's a great conference. We've been fortunate enough to be down there last year. I've been down in years past, and I think this could be one. A lot of people, everybody talks about the Arizona conference and Davos and those types of things, but this is as important a conference as there is, and it's happening very early in the year.
Yeah, it's really interesting, Guy. When we were doing the preview of it last year, the sentiment was pretty dour, if you think
Hmm.
about it. And we were like, holy, we were wondering what the mood was going to be. And look what happened since then. So, again, this will be really interesting for us to get a sense of what the vibe is there amongst both investors and allocators. And plenty of pundits will be down there too. All right, stick around for our conversation with Ron Biscardi. He's the CEO, founder of iConnections, and we're going to talk all things global alts.